Now, we always want to review, of course, some recently posted content from last week's presentation, the different segments. In addition to that, a new presentation that was put up this afternoon. So recently, in the past 7 days, we put up quick questions on time decay and time value decay of options. A discussion on, is it better to roll on Friday or close on Friday and then wait till Monday to sell a new covered call if you're trading weekly covered call positions. We had some discussion on thoughts on halfway through and some questions that came in related to trying to be your own fund manager and what to look for maybe in the next half of 2022. We spent 20 minutes taking a look at the Market Sentiment Tool, which went to a very bullish buy last week, and we were analyzing that and tended to work out a little bit okay this week. It wasn't rip-roaring, but it was a good, strong end to the week as well. And then today we posted the Married Put discussions, how to screen for ETFs using the radioactive Married Put technique, and should I add a put option to a stock that's already down as a Married Put for a potential repair position. So we walked through the thoughts on that and some various ideas as well. And of course, always want to check out on YouTube our playlists if you're just starting out in a strategy, whether it be a covered call, call buying, debit or credit spread. Check out the playlist. There's about 9 to 10 videos in each of the different strategies. The videos are designed to introduce the strategy, go through criteria discussion for searching, tools for analysis, comparisons to different structures, different probabilities, different returns, and also videos in each section on managing a winning trade for potentially more profit or managing losing trades in that strategy as well. So you want to check that out there, and if you're getting started in a new strategy or even if you just need some refreshers. All right, so what have we done here on the market sentiment with the recent market movements today? Ooh, boo. I got out of this. I bought a call on SBUX in addition to having my Married Put there when it hit down below 74, 75. So I took that off a profit today for a 4 or 5 day trade, but I missed the top. But that's okay. I hit my target trading plan, so I'm happy with that. But going back to last week, of course, hitting the 17th, the 21st, that's where we started hitting the very bullish buys. Low price here, which looks like 3,666, and we're back up to 3,900. So 250 point gains since the very bearish buys. Very bearish buys, Mike, please. The very bullish buys began to start triggering in earnest. Not a huge move, but it went right back to where it was when it was a light buy. We're back up to 39.11 in that case, and back to just a light buy recommendation, suggestion here for the market sentiment. So again, we covered that last week on talking about what goals we might look for when the market sentiment starts showing these very bullish buys. I'm told what actions we might take of managing Married Put positions. Of course, we had that extra day off on 620, but managing the Married Put positions, we see the very bullish buys, maybe opening new positions as well, taking some profits or looking to jump into maybe some potential long calls and bull call debit spreads, perhaps bull put credit spreads. That was our discussion there. When we've hit the bottom and when we see the bullish buys come up, what are we looking to do? And that tended to work out this week, even if we didn't hit our targets, but I did manage to hit my targets on 2 or 3 of the new positions, quick positions that were opened from last week as well. But Victor's comment here is today's market sentiment shows mostly bullish. It's a light buy. We've got 6 buys, 6 neutrals, and 1 that's bearish. He says, but the put call volume is the indicator that's bearish. So let's take a look at the indicator details here. That one has moved into the bearish fence range. And we see we still bullish on the VIX, the trend. SPX stays above the SMA 100, gap over the 100. It's more longer term ones there, indicators. But Victor says, how much weight does that indicator have over all the others? They're all pretty much even weighted, okay? Indicator weight is 10. So let me just take a look here. I think they're all at about 10. Maybe the VIX is not. No, it's 10. Trend. Okay, so I'm pretty sure they're all in that range, Victor. They're all pretty much evenly weighted is how Ernie originally set it up. So although this one might be bearish, others might start slipping to that too. But what it's telling us is that in this case, that's the first one that went bearish. Why would it be going bearish? Because the market sentimeter sort of gave us an indication of what was going to happen, and it did. 36,666 when we started hitting those very bullish buys, 36.74 in the second very bullish buy indicator, up straight to relatively straight to 39.11. So if on Monday the bulls still are roaring slightly, or waking up from hibernation, or hiding, we should say, and the market goes up to, SPX goes up to 39.50, maybe it hits 4,000 again, maybe it moves up a little bit more, you're going to see a lot more go into neutral. Many of these sixes are going to start to swing into the neutral, and this light buy might switch to neutral. One or two might even go to bearish. But that wouldn't necessarily trigger a bearish warning. You usually need about 4 or 5 indicators. I think it's 4. Yep, it looks like 4. 4 indicators on the bearish side to start seeing a sell warning. And that's not really when we take action. If we see a couple of these bearish sells or strong bearish sells in a row, that's when we'll start maybe looking to make adjustments, adding protection, rolling down covered calls for more protection potentially, or exiting bullish positions that are winning before the market may start to turn. But sometimes those valves, as I mentioned, ease off again, and you go back into more of a neutral, tame market, and then you start to get some triggers because things started to drop and things started to show a little bit of decline, and then you start to get to those really bullish areas and bouncing around back and forth there and fighting it. But it usually takes a few more. They're pretty much even weighted, Victor, is my answer to that statement there. And that's what we look for. Okay, so Victor, I hope that answers your question. And if you do have any other thoughts on that, just let me know again later on via email or coaching session. I'm sorry, Victor, my apologies. All right. And of course, we talked about the presentation that was posted this afternoon regarding using the Married Put tool to find various ETF positions. There's only 2 or 3 that have been coming up in the search results recently. I've seen PLAB. That's been moving pretty well. Those of you that remember a few weeks ago, we were talking about the FNKO Married Put, and I sort of missed that one. It jumped 10%, 12% the other day. I've heard there was some good news that it was buying into another sort of similar toy company. And so the thing's now up at 23, and it came up on the list for the Married Puts when it was at 18, then it went up to 20, then it went back to 18. Yes, I lament not getting into that one, but we're happy with the way the other position's going. But I've been watching this PLAB one that's been coming up in the results too. It's been doing pretty strong now that things have taken into place as well. How did we manage the Married Put positions? The newest Married Put positions, honestly. Well, it did kind of interesting. I was very happy with it. I think I'll go to radioactive trading. So the most recent position that I entered into was on SBUX about 10 days ago, 12 days ago. And let's see the view details here. I know you're not seeing it yet. There we go. Okay. All right. So on the 7th, a little bit more than 14 days ago. It was 20 days. No, 17 days ago, Mike. Opened SBUX, bought the stock at 78.89 and bought the November 80 put for 7.75. So it was a risk of 7.7%. And then, of course, the stock began to pull back with everything else shortly, last week or so. So on the 17th, last week, it was Friday morning, I believe, we used one of the income methods there that took the risk up to 8.4%. But what we did is our 80 put had now moved up to 12.32. We rolled it down in strike and in shorter time period from November to September to pay only $7.55. So we got almost $5 off of the cost basis on the position. Okay, $4.50, but we got close to $5 off the position. What did that do? The percentage risk went up, but we lowered the break even on the position. And now as the stock started to move back up today, what we were able to do, the stock went up to 76 or 77. I forgot to put in the stock price. I usually always do that. I'm sorry. So I did this one when it was 71.32. We rolled the put down and closer in. The stock today was at 77 something. Oh, I'm sorry I didn't put that in. I always remember to do that. I guess I didn't this morning. However, we rolled back up, kept in September, but moved from the 75 to the 80 put. We only paid $2.50 for this adjustment to gain 5 points higher payout, and that took the risk down to 5.2%. So even though the position was down, even though the position fell and was down about 7 points, almost 10% from when we originally got into the position, from 78.89 down to 71.32, we were able to make an adjustment based on our SIGA model, which is described in the blueprint for each of the 10 income methods, to lower the break even sort of average down without adding more costs in the position, taking advantage of our second asset, the protective put. And then as the stock recovered as we hoped and expected, when we started to see the buy warnings, we were able to roll back up. So in the first 17 days, we have been able to reduce the risk from 7.7 down to 5.2%. And I still have the opportunity, wanted to do it today, but didn't get a chance to, but probably do an income method number 6 or number 1 on this trade, just selling the call or doing a bear call credit spread to lower the risk further and either just generate some income, treat it as the collar spread, or go ahead and make the adjustment going forward. But what was interesting about this is after rolling down the put here, my apologies, rolling down the put here, having that higher risk, when the stock reached close to 77 today, I could liquidate it for gain. If I had still been in the original put, I still would have been down about 2% or so, with the stock moving back up to 77 or 76. Actually, it's about 1.5%, I think, when I calculated it out, what it would have been worth. But again, that's sort of the advantage of not only the income methods in radioactive trading, but at the same time, how we can manipulate that put as a second working asset in different market periods, different time periods, based on what you think the market conditions are and your expectation for the stock moving back up as well. I haven't recorded that into this portfolio in that case. Okay, so we talked about the market sentiment tool a little bit background there, and we talked about those positions there and that call. What was the other position? I'm sorry, let me go back here. We were looking at positions last week. Did I put it in there? No, I didn't. Oh, we did. Okay, so sorry, folks, ladies and gentlemen. Back from 6/10, 14 days ago, we were talking about the deep in the money bull put credit spread for Don, deep out of the money, bull put credit spread for Don, and that adjustment there. And you saw us review last week this position. This was the sample strangle we were talking about on SPY, which we would have closed when this profit was actually, we looked at it last week. I think it was 200% profit, 110% profit. I can't remember. This would have been rebracketed at that point. And we had the 423, 395 bought when the stock was trading around, SPY is trading around 410 or 405. With the big move down, and we saw it go down to the 3,700 or 370, I should say, we would have closed and taken off the profits of that position. That's recorded in the other portfolio, not in the webinar portfolio. And we moved it down to different strikes. I believe it was a 400 and a 3,500 put, or 350 put and 400. I don't think it was 50 points apart. It was whatever the 0.3 deltas were. We might take a look at that next week. But I wanted to show this as an example. When we talk about these different strangles that we might use on broad-based ETFs, broad market ETFs, things of that nature, when we see a profit on one side that's 50, 70, 100%, that's when you want to rebracket the position, because if you don't and you leave it as is, you go right back to almost break even or a small profit in a matter of a few days. This went from a huge profit, I believe almost $1,000, $2,000 on this, now it's $1,200 or $1,000, to only a gain of 70 without taking action in those positions. So when you do the strangle positions, you've got to readjust when you hit your profit targets. Even though you're losing almost complete value on one side, you got to manage the other side when you see the profit targets right away. Rebracket the position, especially if you see it go from a sell market to a buy market. Your sentiments change from bearish, to where the put side of the strangle worked well, to bullish. They're active as well. They're not just leave the position alone and hope you get a wild swing and close it at expiration. To be successful with buying strangles on the broad-based ETFs, you've got to be able to move with it, and you've got to be able to adjust those positions. Those are just some of the things we talked about last week. We did show the rollout for this position last week, so I might as well just do it again. It's 435 and 685, right? Yeah. And the September 685. So we just rolled up from the 75 income method number 4 in the blueprint to lower the risk from 8.4% down to 5.2% on the position. And yeah, so we did that when the stock, I think, was around 77.60 or 77.50, somewhere around that time period. So as it moved up a little bit more, of course, the put pulled back in price, but that's fine. We could still sell 80 calls against it or do a bear call spread against the married put position we have in Starbucks right now and further lower that initial risk. All right, well, ladies and gentlemen, we are at 5:30 p.m. Eastern Time. All right, I just wanted to remind everyone, of course, today that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options do involve risk and may not be suitable for all investors. Now, we had a chance to go through the portfolio tools a little bit today, attempting to evaluate some rollout opportunities and adjustments. And we showed how you could use the custom spread tool to help you build and analyze different types of repairs for various strategies. Didn't get into the search tool much today, but we did talk, of course, about the market sentiment a little bit and the changes we saw as the market increased and the valve sort of eased a little bit. We went from that very bullish buy to still a light buy as the market increased. But remember, you could take a 14-day free trial at any time. Just put in your first name, last name, and email address at PowerOp.to and click Start My Trial. We'll email you a password. You'll have full use of the site for 14 days. No credit card is required. After that, subscription level start at just $45 per month for the end-of-day data service. The upgrade to that is the delayed service, $65 per month. So that means anytime you run a search or an analysis, you're looking at data that's only delayed by about 15, 16 minutes or so. The historical service add-on gives you full access to the 7.5 years of historical data for backtesting purposes that we have. So it's just $100. That includes the delayed and the access to the historical tools. And then, of course, we do have the real-time service. You can cancel at any time. There's no contractual obligation. You can also upgrade at any time. Subscribers have full access to all of the webinars in the archives. And, of course, you can schedule a free coaching session at any time on any level of subscription. At the beginning of the presentation, we did talk about some of those archived webinars on managing long calls in the playlist. Remember, you can take a look at those on Power Options in the archived webinars, looking at the tools, strategies for options concepts, or you can go to our YouTube channel and you can take a look there as well, searching for content or viewing the playlist for the strategies that meet your goals and what you're looking to educate. Now, if you think you do come across any questions at any time, remember, you can just send me an email to support@powerop.com or support@radioactivetrading.com. And call us during market hours at 302-992-7971. Of course, remember, trial members and subscribers can schedule a coaching session at any time.